Michelle Meyer is here to talk to us more about it. She's a senior U.S. economist at Bank of America Merrill Lynch. Last week, her team bumped up their forecast for third quarter GDP. Michelle, so does that mean we are in a recovery at this point?
We've been in a recovery. It's just been a feeble recovery. So the story really hasn't changed. I think what we've learned from the recent data is that perhaps the economy is not falling into recession. There's smaller chances of the recovery faltering, but it still shows that 2.5% growth, although it's a lot better than could have been feared, it's still a soft pace of economic growth.
Do you think Obama's jobs plan and other economic stimulus packages could help boost growth even more?
It could be helpful. Policy support, I think, is essential. Our baseline view, however, is that Obama's jobs bill will not get through in any form. We also don't think that the Super Commission will come up with a real credible plan. So we're looking for a good amount of fiscal austerity into next year, which is why we're more pessimistic about growth next year than we are even about the next 2 quarters.
Well, what are you going to be looking at in today's GDP number to help determine what comes next for the U.S. economy?
I think there's a few crucial elements. Consumer spending is key. The consumer's been the weak part of this recovery, and I think that we're going to continue to see some softness here. Auto sales, we know, have popped higher, but outside of autos, discretionary spending is likely still soft. And business investment, I also think, is really important. That's been the strong part of the recovery. The corporate sectors continue to spend. They have cash on their balance sheet.
But you talk about autos. What if gas prices go back up?
And that's a headwind, right? So that's one of the reasons that growth looks actually a little bit better in the second half of the year is that the oil prices are coming down, and that supports consumer spending. If that reverses, that's going to hurt consumers.
Europe has been the big wild card in any economic outlook. Are you satisfied with the deal and how it will impact the U.S. consumer confidence, investment confidence, and ultimately the economy?
I think it's certainly a move in the right direction. Consumer confidence probably will be boosted at least somewhat from it, but I think it's a long road ahead, and it's going to be a bumpy road. And I would expect to see the European economy remain on a sluggish foot, and global growth in general is likely to be pretty feeble in the next year or two.
All right, Michelle Meyer, thanks so much for stopping by. Senior U.S. economist at Bank of America Merrill Lynch Global Research. She says it's going to be sluggish in Euro, but she's looking for a pretty positive U.S. GDP number today.